I know that you joined UBS a few months ago, and a big job you're facing in revamping investment management at UBS in an environment which is fluid, if not highly volatile.
It is the understatement of the year. Highly volatile is truly the way to describe it. I think a few weeks ago we had something like 4 days of 400-point movement in the U.S. equity indices that were unprecedented.
So how do you think investment over the next 20 years is going to change from the last 20 years, or even less than that? Because it seems as though the problems that sparked this volatility, they're not going away anytime soon, right? This is something that we're going to have to get used to.
You hit the nail on the head. We're in a deleveraging process of really massive and relatively, I'd say, unprecedented proportions, and we're just in the beginning in the United States and in Europe. If you try to put the historical context on the world we live in today, you have to go back to basically 1980, when Ronald Reagan took office in the United States and the U.S. shifted from a nation of savers to essentially a nation of debtors. And we've had the blips along the way in 1987, 94, 98, 2001. But essentially for the last 30 years, we've been in a rising tide environment. And so to your point about investing in the future, I would say that a lot of people have misunderstood performance over the last 20 years, and they have said we have gotten alpha, when in fact most people have gotten levered beta. And we're in a deleveraging process now, and will be for a while, for years. And you don't get a rising tide dynamic in a deleveraging process. It's much harder. You have to be much more insightful about where to find outperformance.
And I guess that means a tough job ahead for you at UBS in their wealth division. And I suppose wealth managers will have to come up with more original, creative investment ideas, given the volatility and the uncertainty dominating markets right now.
Yeah, undoubtedly. I would say, though, it is a great time to be a chief investment officer, because if you're insightful, if you're good, you should really distinguish yourself from your peers.
And what needs to change then at UBS to adapt to this new environment?
Well, one of the things we have done is to create a really industry-leading investment process where we bring together all the different assets across our investment bank, our asset management group, our wealth management group, and try to provide market insights both from a top-down perspective and also from a bottoms-up perspective, and leveraging 60,000 plus people in every major region of the world, which gives us pretty unique market insights for investment management business.
About 22% of UBS's wealth management assets, excluding the Americas, were cash holdings at the end of 2010. In this environment of fear, how difficult has it been to convince your clients to invest that money?
Well, you have to look at cash in a relative way. We are in a period right now where, until there is some resolution around the European sovereign debt issues, there's a lot of logic for people holding cash and waiting to determine what the right time to invest is. However, you can't market time stuff. So people need to look at kind of the volatility we're in with a level of nuance that is sometimes missed by investors. The first point I would make is that when there is so much volatility, people tend to hold cash, like you note, and they also tend to gravitate towards safe haven assets. Safe haven assets are often thought of as, say, the gold or the Swiss franc or U.S. Treasuries. We live in a supply-demand world, though, so safe haven assets can quickly become bubbles in and of themselves. So it's important for clients, and we try to help clients understand this, to take a longer-term perspective. It's easy said and harder to be followed in a time of real volatility. But if you're in the wealth management industry, you have an innate opportunity, which is you can think about the world over years, not days or weeks.
So if you are a longer-term investor, where do the good opportunities lie?
Well, you got to be a UBS client for me to give you that in detail.
Okay, yeah, go on.
No, I'll give you the light version. You know, we have thought for a while, and still do, that there are opportunities for a longer-term investor in industry-leading companies in certain defensive sectors that have strong balance sheets, that are cash flow generators, that have their revenues highly diversified across different regions around the world, and that critically pay dividends, and attractive dividends. when you look at the yield on, say, U.S. Treasuries, you're not going to keep up with inflation over 5 years or potentially over 10 years. So it's important to look at high dividend paying companies, particularly well-rated companies that are positioned attractively in their industry. And that's an area of great opportunity for long-term investors.
But do the steep share price falls over the past month perhaps suggest a lack of trust and confidence in next year's earnings forecasts, even for those industry-leading high dividend paying companies?
Well, I think there is one important lesson which came out of 2008, perhaps above all else, which is in a panic, everything is correlated. And I think we have been in moments of real panic over the last few months, and we may have more volatility like that. And when people panic, they tend to lump everything together. And as most people who think hard about investing know, when everyone is heading in one direction, there's usually opportunity in another direction, especially if you have the willingness and ability to hold through periods of volatility. Same could be said for equities.
I'm just wondering about the psychological risk to this strategy, given that much of the sell-off, according to investment officers and many other analysts and economists, much of this sell-off over the past month was driven by fear and panic. The psychological risk to the idea that deteriorating sentiment in the markets feeds through to the economy, it impacts consumer confidence, demands for goods and services, and then impacts the companies, and you see this vicious circle forming that's difficult to get out of.
I think you're describing what some people refer to as a feedback loop, and there is no doubt that a feedback loop is both powerful and it can be vicious. And this is particularly relevant around the European debt crisis. Just a couple quick comments on that. There seemed to be a bit of a waiting for Godot dynamic. You know that famous play book by Candide, Waiting for Godot? Everyone is waiting. When is Godot going to show up? We are waiting for when the European political leaders will come together and recognize that they need to actually move towards some kind of a fundamental fiscal integration. And a lot of that depends on Germany, and it depends on the political leadership that Chancellor Merkel can demonstrate. Now, the dynamic when it comes to the feedback loop is there is real concern that Chancellor Merkel will have to kind of walk to the edge of the cliff in order to demonstrate to those in her constituents and her political party that the issues are fundamental and they need to be addressed, and Germany has to do it with real leadership. And as you know, when you walk to the edge of the cliff, you can slip. And so the concern for many market watchers is that Europe will stumble, and if Europe stumbles, the feedback loop will carry over to the United States. And so the volatility will probably remain until we have some resolution in the next few months over the European debt crisis.
Well, so after the unpredictable choppiness of August, what can we expect in September? More of the same?
Well, I really think what I just said will be the best guide to that, which will be until we find some path forward around how Europe will address its fundamental issues, there will be more choppiness.
Okay, so with that in mind then, what are you concentrating on? What are you concentrating on in September? Which countries, which policymakers, which indicators are you focusing on?
We're really looking to Germany. We're waiting to see what kind of leadership Germany is able to show domestically and then internationally. At the end of the day, we think of Germany as largely the economic engine in Europe right now, and the decisions they make and how they handle their domestic political issues will, we think, heavily define how Euro issues are resolved.
Germany facing significant challenges at home that I suppose restricts how much Chancellor Angela Merkel can maneuver right now with slowing growth in their country and also in France. I'm just wondering about economic growth in many developed markets now, which seems to be poor to stagnant. Are you worried about another recession in the US or Europe?
Well, I think everybody is focused on the data. At the end of the day, all we can do is look at the data and try to interpret it. There seems to be no doubt that both the US and Europe are experiencing slow growth, slower than many had estimated. One of the key indicators that everyone is looking for comes out this Thursday, as you know, the ISM numbers in the United States. The question really is, are we in a period of slow growth? Are we in a period of contraction? Or are we in stages that will be looked back and defined as a recession? I think for many, until we see the data that we're actually in a recession in the United States, the assumption is we're in a period of slow growth. And some data that's come out, as you know, has been pretty positive recently, including the auto sales numbers in the US.
And I'm just wondering about the banks in Europe and their ability to fund themselves. Are financial institutions stronger now than when Lehman Brothers collapsed?
I think undoubtedly.
Do you think banks could have a difficult time in September, face rising funding costs? There's been concern about that recently.
Banks are stronger than they were in 2008. I know the head of the IMF recently made a point about this in her Jackson Hole speech. There's been disagreement among European policymakers over whether there is a real issue the way the head of the IMF noted. There is a feedback loop which comes into play, as you noted earlier, around overall volatility and concern in the markets. But right now, a banking crisis is not first and foremost on most people's minds.
Are you anticipating more stimulus from the Fed in September, and would that put minds at rest?
I don't think most market observers are anticipating more stimulus from the Fed in September. I think Bernanke was relatively clear in Jackson Hole, as much as a Fed chairman can be, which is at this time the economy is actually moving forward in the United States, slow growth, but moving forward, and that a lot of the issues that need to be addressed are in the fiscal realm right now, and that government, specifically the Obama administration and Congress, will need to move forward effectively in order for there to be progress.
So what are you watching for then from President Barack Obama's speech on economic policy after Labor Day? Do you think that we will see much on the fiscal side of the situation, perhaps some progress on the job creation programs, investment in infrastructure, or do you think he is limited in what he can do politically?
There are really two issues that we're looking for in the United States. First has to do with jobs, and the second has to do with housing, and they're intricately tied together. As most people know, the U.S. is heavily driven as a consumer economy. Something like 70% of its engine is consumer spending. People feel poorer when they feel like their house is underwater and or when they feel like their house prices are not rising. So house prices are issues and are key issues. And obviously when you don't have a job or when your job is paying you less than you're used to, that obviously affects your consumer spending profile. So we look to see what the president will do around both the housing situation and obviously around employment. And more broadly, after the debt ceiling process and all the issues that were not handled ideally, we're looking to see what kind of a dynamic the president is able to establish with Congress.
Can I ask you about the outlook for Switzerland right now? Because the Swiss franc and its strength is turning into a bit of a nightmare for businesses and exporters. The Swiss National Bank's action seems to have been largely ineffective in tackling this. Will they need to consider last resorts of pegging the currency to the euro or introducing some sort of floor level for the franc?
Yeah, that's a great question. Living in Switzerland, when you go out to dinner, you can see how expensive everything has become. And obviously for an export-driven economy, it's very difficult when the currency has been on the trajectory it has been on. I would actually say, though, that the central bank in Switzerland has been effective recently, and that the currency you'll see is starting to weaken against both the dollar and the euro. The issue of a peg against the euro is a really fundamental one, and it was raised, but I haven't seen yet the central bank following that trajectory. But actually, the movements in the last week have all suggested a weakening of the currency.
But I suppose there are fears that if panic returns to the markets, then it could resume its rise.
Yeah, like I mentioned earlier, the Swiss franc falls into the category of a safe haven asset. But there is always a tipping point where a safe haven asset starts to defy gravity, so to speak. And when there are implications for a country, like you have in Switzerland with respect to exports, then policymakers take pretty aggressive action.